Hello investors and traders out there. In this video, we are going to be exploring everything related to call options. I hope to demystify an otherwise very complex topic. So sit tight, relax, and enjoy this video. Before trading call options, we must develop a working definition of what call options actually are. Call options give the holder the right to buy 100 shares of an underlying stock at a specific price known as the strike price up until a specified date known as the expiration date. For example, a single call option contract may give a holder the right to buy 100 shares of SPY stock at $277 per share up until the expiration date in 3 months. There are many expiration dates and strike prices for traders to choose from. As the value of SPY stock goes up, the price of the option contract goes up and vice versa. Now we're going to break this wall of text down and look at a ton of examples to bring clarity to what this is actually saying. One of the key components of call options contracts is that they provide the investor with what we call leverage. Call options give the holder the right to buy 100 shares of an underlying stock at a specific price at a later date in time. And so when you buy call contracts or call options, you are buying the right to purchase 100 shares at a later date in time. This is a very important concept that you must understand. Call options provide the buyer with leverage. They give you tremendous opportunity to make an incredible amount of money relative to buying the stock outright. We can actually calculate the incredible leverage provided by options contracts. What we do is we take the current share price of the individual stock or ETF that we plan on trading and we multiply it times 100. And so in this example, we are using SPY. We take the share price, the current share price of $277 per share, and we multiply that times 100. That gives us a figure of how much money we are actually trading with a call options contract in stock ticker symbol SPY. You can see that one options contract is currently controlling or tied to $27,700. And so what we get from this, what we derive from this, is the idea that options contracts are leverage. When you are trading options contracts, you are trading significantly more sums of money than if you were to buy the stock outright. And so idea number one, when you buy a call contract, you are betting on the share price of the underlying stock to increase. Idea number two, when you buy a call contract, you are buying the right to control 100 shares of the underlying stock. Idea number three, options contracts are highly leveraged. Idea number four, when you buy a call contract, you are betting on the stock hitting a specific price at a later date in time. This is also known as the strike price. Idea number five, options contracts can increase in value quite significantly, but they can also expire worthless. If you purchase an options contract and it isn't in the money by expiration, it will in fact expire worthless. And so now we're going to take a closer underlying look at some real world examples in the options chain. This is the options chain, as I'm sure many of you have seen before. It's nothing to be afraid of. Everything that we just learned will be put into practice and use. In the middle column, we have what is called the strike price. This is what we are betting for the stock price to gravitate towards. This is essentially where we are placing our bet. When we pull up a chart of stock ticker symbol SPY, which we are using for this particular video, we can see that SPY is currently trading around $277 per share. By buying a call option, we can bet for higher prices in stock ticker symbol SPY. We can buy $279 calls betting that SPY will hit 279. We could bet that SPY will hit that within 3 days, within 4 days, within 6 days. We can go out further in time. But the deal is, when you purchase call options contracts, is that you are going to have to pay what's called a higher premium the further out in time that you go. Now, the key reason for that is because options prices are based on what is called the Black-Scholes model. The Black-Scholes model takes into account time premium, and so we have to pay more in order to give ourselves more time to get the story right. And so when we see the 279 calls that expire in 3 days are only trading for $25 each, well, the same calls that expire in 6 days are actually trading for $95 each. And so the key distinction that I want you guys to notice and hone in on is the idea that the further out in time you go, the greater probability of success you have, and you have to pay more for that opportunity when it comes to options pricing. And so we can see as we go out further in time, you are going to have to pay more of a premium for these options contracts. Moving along the options chain, we have something called open interest. This is an amazing thing that we should pay attention to. Regardless of what stock we're researching, we see huge institutional investors take positions in options contracts, whether it's call options or some other form of options contract. We can actually see how investors in the market are participating in the options chain. And this can give us some insight into where share prices are headed. Sometimes we'll see a huge institutional investor get into a call option position, and this is something that we can use in order to forecast where share prices are headed. It does sometimes give us some insight into where we are headed in the markets. Now, moving down the row, we also have volume. We can see how many particular options contracts were traded on that specific day. In order to figure out how much a particular options contract costs, we can actually head over to what is called ask. As you guys know, in the stock market, we have what is called the bid and the ask. The ask is the price that we pay. The bid is the price that we sell out. And so in order to calculate just how much it costs for this options contract here, the $275.50 strike price call options expiring in 4 days cost $255. Going down the row, we can see the 276 calls cost $217, and further down along the row, we multiply and we convert this into dollar bills. So 0.71 actually costs $71 per options contract. Now, just to put into perspective how much leverage you are getting with a call options contract, this particular contract costs $71, but you are controlling 100 shares of the S&P 500 or SPY. Now, to put into perspective the tremendous leverage provided through call options or trading call options, we can actually multiply the current share price of SPY, which is $277. If we take a look right here, SPY is currently trading around $277. As you guys know, options contracts give you the right, but then not the obligation to 100 shares of stock at a specific date later in time. And so we multiply 277 times 100, and that brings us to a figure close to $28,000. You can see here $27,700. And so when we turn back to the options chain, we can see that for only $71, we are controlling $28,000 worth of stock. Call options give you incredible amounts of leverage. They move very quickly. Now, just to put into perspective the tremendous opportunity that call options give you, we can actually look at a chart of call options prices. We can see that in a single day, just how fast these contracts have moved. They moved from $225 up to $270, back down to $230, back up to $280, back down to $210, back up to $250, back down to $220 each, ending the day at $281. If we look at these same call contracts on a monthly time frame, we can see that these particular contracts could have been purchased for $30 each, in a very short time frame, in less than a couple of weeks, they have ran up from $30 or increase in value from $30 per contract all the way up to $281. That is a 400% return, or 4 times your money in less than a week. Call options can be incredibly lucrative. You can make huge sums of money trading call options and investing in call options, but we also have to highlight the risks. There are risks associated with trading call options contracts. As I'm sure many of you guys know, or who have engaged in trading call options before, call options can expire worthless, and so we do have to touch on option expiration. We can see that SPY is currently trading around $277 per share. Let's say hypothetically that we were going to buy a call option that were to expire in 1 week's time frame, trading around $283. A $283 strike price is what we're betting on. We can see those are currently trading for $2 each. And so the underlying reason for that is because investors assume, Wall Street assumes that this is an unlikely outcome. The probability of success is very low, and so the market is willing to sell those to you very cheaply. And so what is taken into account in the options contracts is the probability of success. The likelihood of a particular outcome is part of the options pricing model. And so typically, as a trader, as an investor, as a speculator, you want to engage in buying contracts that will give you the highest probability of success, the greatest likelihood, and that is what is called in the money options contracts. In the money means that the given strike price contract that you purchase is below the current share price. And so we can see SPY is currently trading around 277. What that would mean if we were to go buy a call options contract is that we would buy a call options contract around 275 strike price, or even below 274, 273. We can see that the premium is much higher, $484 for this particular contract, or for the $275 strike price, almost $300 for this particular options contract. The underlying reason for this is because there is a much greater likelihood that these options contracts will not expire worthless. When you look at what we call out of the money, any strike price that is above where SPY is currently trading, remember SPY is currently trading around 277, those options contracts are much cheaper because Wall Street assumes, the options pricing model assumes that the greatest likelihood or outcome is that SPY will not be trading at these levels in the future. And so we always have to keep in mind and take into consideration the likelihoods, the probability of success whenever we are buying and selling and trading options. This video was the beginning of a series of videos where we will break down and dissect options trading, how it works, and how you can become a significantly more profitable options trader yourself. There is a lot to this. There's no doubt about it. There is a lot to learn about options trading. It's taken years for me to master, and there's still so much more to learn each and every single day. But there are a few things that I want you guys to keep in mind as call options traders. When you buy a call contract, you're betting on the underlying share price of the stock to increase. When you buy a call contract, you are buying the right to control 100 shares of the underlying stock. And keep in mind that options contracts are highly leveraged. They move very quickly. In some cases, they can move 30 or 40% in one day or even more. When you buy a call contract, you're betting on the stock hitting a specific price, what we call the strike price, at a later date in time. And often we have to pay a higher premium for a greater likelihood and probability of success. And options contracts can increase in value quite significantly, but they can also expire worthless. And so we broke down what a call option is, how it works, how you can make a ton of money buying and selling, trading and flipping options contracts. In the next video, we will explore buying put options, everything about put options in great detail. As always, guys, I hope that you enjoyed this video. Be sure to smash that like button. Let me know if you have any questions. As always, guys, thank you so much for tuning in, and I will catch you in the next video.